Hello everyone, welcome back to part 3 of the Day Trader's Beginner's Guide. In this mini-series, I'm going to go through a list of topics that I think are the most crucial to understand, which could overall increase your success in the market and also give you awareness to the fundamentals before you decide to enter the market. It's always good to do tons of research before you dive anything that can have serious consequences, such as losing money. And in this topic for part 3, we're going to go over the basics of risk management. And specifically, what we'll go over is basics of risk management. How do emotions affect trading? Controlling emotions, fear, greed, patience, discipline, and confidence. Did you know that 95% of traders that go into the market with zero game plan and no risk management plans whatsoever, they end up getting liquidated every single time? Their balance eventually diminishes because there's no plan to actually prevent the amount that they lose. Because if you can't prevent how much you lose, how can you protect your capital? If you can't protect your capital, how can you preserve it? And then how can you grow it? Capital is the number one most important aspect, and you need to protect that because most traders, in my opinion, they need to think about how much they can lose. But the majority of traders, they go into the market really new, thinking about what kind of strategies should I be learning? Let's learn all about technical analysis. What are the best strategies to use? And the last thing that they focus on is risk management. So this might not be the funnest topic for a lot of people, but if you actually focus on risk management and focus on developing a plan that's going to last long term, that's going to prevent you from turning small losses into catastrophic ones, it's going to help you long term and be profitable. I've heard so many traders and of stories of how people were just down a small amount, but they ended up turning that very small loss into something catastrophic because they're a deer caught in the headlights. And whenever you're down a small amount and you don't have a plan or the discipline to cut your trades, that trade could turn into a massive one. And then when it turns into a catastrophic loss, you're paralyzed. You're like a deer caught in the headlights, just standing there wondering what you should do. And a lot of newer traders, they go through these emotions, and the majority of times they're over leveraged as well. So because they're over leveraged, if the market drops even further, when you're in a long position, they end up getting liquidated. Then they go back into the market when they get a little bit more capital. They try to do the same thing with a better strategy, but it just doesn't work out because they lost a very similar way. The number one reason why traders either fail or they're successful is because of their risk management abilities. You simply cannot protect your capital if there's no plan in place. So I'm going to go over some of my successes and failures and some of the things that I've learned over the past 8 years that can hopefully give you an idea of some of the things that are very important when it comes to trading. And this is designed to be an introduction to day trading. So it's not an advanced guide in any way. So you can do more research yourself. And if you're extremely interested in learning more as well, there's always my masterclass course. That's the complete day trading guide. It gets you a lifetime access to my Discord group and a lifetime access to me as well. So you can ask questions, and I do a live stream every single day, 5 days a week. We do a technical analysis on Bitcoin. We do a market live scan, and we also build a watch list together. It's a community of very like-minded people, and you can find out more in the information down below. When I first started out trading, I was putting in about $600 a week into my trading account. That was all the money that I had, and it was going 100% into the trading account. And my first huge mistake that I didn't realize later was that I was focusing on the profits and what I could make every single week. I didn't even think about the losses that could be incurred at all. I was thinking to myself, hey, if I made 1% of $600 every week, if I compounded it, it would turn into a huge number over time. And that was absolutely true. And I was always thinking about the profit. It was the number one priority. And then much later, I realized that if I could do things completely differently, I'd probably go back and tell myself, the profits come as a bonus when you get better as a trader. And the most important thing that people should focus on right now would be to make the good trades first and focusing on managing your risk. So if I had to go back in time, instead of putting in that $600, because I didn't have a lot of money back then, my net worth was next to nothing, I would have told myself, only allow amount of risk that you are okay to lose. The best advice that I can give you if you're starting out as a newer trader or somebody that's starting to develop your risk management plan would be to trade small. Don't trade your entire net worth, your entire paycheck that's coming in. Putting in a gigantic balance with the goal of profiting rather than learning, because that's the exact mistake that I made. And I wish that I knew much better back then to play smaller, because then I could have used it as a time to learn rather than blowing everything that I couldn't really afford to lose at that time. And just as an example, it's kind of like if you're going to go on a vacation, if you're going to have an event of some sort, you're going to budget what you can spend on this event, of course. It's no different than trading as well. You need to budget what you can actually lose and be realistic with yourself. There's a really high chance that you're going to blow everything that you put into the market the first time. And if you think about how competitive the market is it really likely that you would outtrade a professional trader that's been doing it for 5, 6, 7 years as a newer trader? Probably not that likely. This professional trader has tons of skills on you, tons of experience and years on you where they've gone through trials and tribulations. They made so many mistakes that they've learned from these and progressed from them. You don't have that experience yet. If you go into the market being as pessimistic as possible in terms of, hey, I acknowledge that I could be losing a gigantic amount of money, I should probably play a lot smaller, you might actually be more successful than the people that go into the market thinking to themselves, hey, I'm going to make a crap ton of money if I put in a lot of money. The goal of trading is to learn at the beginning. And I think that the position sizes that you play, you have to earn them. And the position sizes that you play, they eventually grow proportional to your skills. So when you start out, you might be playing only a few $100s. So for example, myself, I was starting out with about $2,000. Like when I was starting out, total bankroll maximum amount that I had. But over about 8 years now, I've grown it to my largest position size that I've played in my life was $1.4 million. And that was just last year. And then this year, I played $1.3 million as well. So these are position sizes when you earn the right to play them, because the strategies are really different when it comes to playing larger sizes. So once again, keep your positions small, go into the market with only what you can afford to lose. This is a way of managing your risk. Risk is simply defined as a way of controlling how much money you could lose. And there's going to be different steps and different levels that you can implement into your risk management strategy. And the first strategy would always be to limit how much you can actually play. If you don't limit how much you can play, you can guarantee that it's going to turn into a catastrophic event. I've heard all these stories before that they go into the market and they get wasted by the market. The market's got a really special way of humbling you as a newer trader. A lot of people get into crypto because they hear about the allure, or just of day trading in general, of making a huge profit in a short amount of time. Yeah, it's definitely possible in a bull market, not with that much experience, but the hard part is actually keeping your profit. So making it is easy, but keeping it, that's a completely different skill set. And many people made a crap ton of money during the bull market in 2017 and last year as well. But most of them ended up losing it back to the market because they didn't have a way of protecting themselves and preserving it. So we have to also understand that these are different markets. A bull market is very different than a bear market. And in a bear market, it's important to really manage your capital so you don't lose it. And the goal is to just hold on and survive, not profit immensely. Because if you survive in a bear market, you can thrive in a bull market. You have to have these assets. You can't lose them. If you lose your asset, which is your capital, how are you going to have any to day trade and do well in the bull market that's coming up? So always play small, protect your capital, and know for a fact what is your limit that you can actually use to trade. That's going to be one layer of protecting yourself. Another layer that you can add to your risk management strategy would be the percentage that you would be willing to risk per trade. So just as an example, a lot of people go into the market thinking that they need to have a lot of money and to play bigger to make a lot of money. But then they end up leveraging, for example, they have a $1,000 bankroll and they end up leveraging that 20 times to $20,000. Well, the market only needs to move 5% because 5% of $20,000 is going to be $1,000. So if it moves 5%, they're going to end up getting their entire bankroll liquidated in a 5% move. And then what happens? Their bankroll is completely shot. They've got to start over again. So over leveraging is one of the hugest risks when it comes to trading. And a lot of newer traders do believe that I need more money to make more money. And I've seen it time and time again when these mistakes are made. It's devastating to them personally and especially emotionally. So after I started making all these mistakes and learning from them, and I realized that, hey, I've got to start protecting my capital. And this happened really early in my career of trading. So after I realized this, I started focusing focusing on risk management. I didn't leverage at all because I realized it's a very dangerous thing to do. Perhaps when the trade was highly confluent and there was a high probability of winning and my confidence was really high, I would have leveraged 3x, but no way you would have caught me leverage 5x or 10x or 20x like a lot of newer traders do nowadays. And the majority of people that do leverage 20x and they keep posting it, you have to wonder, like when they're posting a good trade and they show it with a high leverage, how many trades did they actually need to make to get this one good trade just so they can take a screenshot of it and show it? It doesn't show any consistency. Over time, the people that end up leveraging high, they get liquidated because they have no risk management skill. When you think about the discipline required to not leverage, how would they also have the discipline to cut their losses? It goes hand in hand interchangeably. If you don't have the discipline to not leverage high, you're also not going to have the discipline to cut your losses when it actually matters. And I've seen time and time again that people are leveraged high, and the market, as we've all seen crypto do, it can spike up, it can spike down tons of percentages in a very short period of time. And when this happens, that's how liquidation wicks just knock out people entirely from the game. So it goes hand in hand. When people leverage really high amounts, they're playing 100% of their balance. So if they're risking 100% of their capital that they have, that's not really a good risk management strategy. A really good amount to risk would probably be an average between 1 to 2%. It really depends on what you personally prefer to do. My 3 general rules when it comes to position sizes, and these are very general advice that I'm giving you based off my experience. This is what I would tell a newer trader. I would tell them that they can trade a position size with 3 different ways. One would be a percentage of the bankroll that they have. For example, if you have $1,000 as your bankroll and you're just starting out, you might want to limit it to 50% that you would trade. And of that 50%, that's $500 that you would be trading, you would probably want to risk between 1 to 2%. This way, if you lose and you go on a series of losing streaks, even if you lost 5-6 times in a row, you can still maintain that $500 position size since you initially only started with 50% of your overall balance. Now, the second way that I would recommend to position size would have a fixed dollar amount. No matter what, even as your bankroll grows, you'll say to yourself, even if I grow it to $2,000, I'm only going to trade with a $500 position size, and I'll keep doing this until I reach, for example, a $5,000 bankroll. Despite how long it takes, this limits the amount that you play, and you're being strict with your position sizing, and this shows discipline, and it's another layer of adding to your risk management strategy. Now, the third way that I would recommend to position size would be to have a variable position size. And what that means is depending on, first of all, the volatility of that particular coin that you're trading, also depending on the probability of winning that trade is also extremely important. And the probability would be determined by how many confluent reasons are there to enter a trade. If you find more reasons to enter a trade and it's leaning much more one way than the other, then your confidence could also be higher as well. And whenever there's a confident trade with a higher probability of winning and more confluent reasons to enter where the stars are lighting up and it's really tilting one way more than the other that you believe, I would definitely add a higher position size than I normally would. So if I've committed to, for example, a 50% position size of my overall balance, if the confidence is really high for a particular trade, I'll probably add more size to it like I normally do. And you're going to come across many situations where there are many confluent reasons to enter a trade and add size. For example, for one of my favorite strategies would be a 5 Elliott wave count that we see, combined with bearishly diverging RSI, combined with a MACD crossover, combined with a trendline break. These strategies of mine that I always look for to get these confluent reasons, when the trendline does break and I end up shorting it, there's a very high probability of me winning this trade. So if I see this setup, I'm going to add much more size than I normally do. And just going back to high leveraging just for a moment, when people high leverage, it's going to be the end of your career if you have the ultimate goal of making money fast and neglecting risk management. So the people that end up leveraging extremely high, they've never built a bankroll to begin with. That's why they're leveraging high. People who have a bigger bankroll, they don't leverage high. They leverage 1, 2, 3 at most. For example, myself, I'll leverage between 5 to 10 now, but it's justified because of all the news with FTX that's happened before and the exchange closing down. I have to be extra careful on an exchange. So I'd rather keep a low amount of capital on an exchange and leverage higher than to keep a huge balance on an exchange just in case it ends up collapsing like FTX. And then if I lose, I'll add more to the balance. But the goal is to keep my funds off of an exchange. It's more of a mitigating type of strategy. And regardless of the reasons these people give you about why they leverage high, it's all BS. These people leverage high because they've never grown their balance to anything substantial before. Like myself, right? I do leverage high, but it's for a reason. But I have obviously grown my account to something substantial already where I can always send myself more money down the road. But if you're new in the market and that's the entire bankroll that you're playing with, you're just going to get destroyed. So you have to implement these different layers of protection to keep yourself from doing stupid things. So this way, your emotions are not nearly as affected when it comes to trading. So if you play your entire bankroll, you're going to be shocked and surprised and in awe when you end up losing your entire balance. So just to quickly review, you have to limit the amount of capital that you're bringing into the market. You don't want to play your entire bankroll or net worth. You're a newer trader. You're still learning risk management. You're not profitable yet. If you're not profitable yet, the last thing you should be doing is adding more money to your bankroll, to your position sizes, because there's a high chance that you'll just end up losing it all. We have to make sure that we focus on learning first and developing proper strategy and discipline so we can grow and protect this capital of ours. The second thing that you should do is limit the amount of a percentage that you lose per trade. And also, the third thing is leveraging. That's a key thing that you should not be doing. Never focus on trying to make money in the market when you're first beginning. Always focus on good trading first and protecting your capital and developing really good habits. So when you're trading, emotions like fear and greed, they're going to come up all the time. And these are emotions that need to be controlled. And risk management, it helps you keep these emotions under control. If you say to yourself, I'm only going to play 50% of my bankroll on the exchange, well, that's one way of ensuring that your emotions are not going to get affected because you've already set a rule for yourself. If you set other rules like, okay, I'm only going to play, for example, 20% of my net worth, I'll keep it on an exchange. Well, that's another rule that you set for yourself, so you don't have to be too stressed out if you lost it because you've already accepted that fact. So risk management is a great way to leave out these emotions of yours. One tool that's commonly used by traders is the long and the short tool that we'll be able to find on TradingView. If you click on right here and then you go to the long tool and you click where you want to enter a trade or are thinking of entering it, then you click on the placement here. This green and red is going to come up. So with this green and red, what it tells you is the risk to reward ratio. The risk to reward ratio is a ratio telling you how much you can win versus how much you can lose. So for example, if you're in a trade where you can win 100 and lose 100, your RR would be 1-to-1. If you're in a trade where you could possibly win 200 but only lose 100, then your RR is 2-to-1. You want to focus on trades that have a high RR because over the long run, you can actually be profitable even if you're not winning more than 50%. A lot of professional traders, they're going to have win rates anywhere between, I would say 60 to even 80%. But traders can still be very profitable even if they have less than a 50% win rate, as long as they're focusing on high risk to reward setups and they're sticking to their stop losses and adhering to these risk management strategies that they're upholding for themselves. So the way that we use this tool is very simple. If you take a look over here, so for example, if you wanted to risk 2% on a trade and then you wanted to get a possible 4% gain, now this RR, if I went up to 4% over here, if you take a 4% possible gain versus a 2% possible loss, that's going to be an RR of roughly 2-to-1. There's a lot of different values on here. Just as an example, this one there and this one here is based off of the ATR. ATR is the average true range that tells you the average value within a certain period of time. So the default one that I use is 14. An amateur day trader and a professional day trader, they'll put their stop losses in different places and they'll use different methods as well. Most newer traders will simply take the low before they're entering and then putting a stop loss slightly below it. But what ATR does is it allows you to figure out the average movement so you can assign the best place when you factor in wicks, because wicks happen all the time in crypto, as we've all seen. And the ATR, based off of the average moves, it helps you decide where the best place for stop loss would be so you don't get taken out. And this is something that's more complicated, which we can dive into more in my masterclass course or in the Discord trading group as well. There's always going to be a lot of fear, greed, patience, discipline, confidence, a wide range of different emotions that you'll be going through as a trader. I know that the scariest feeling is being in a trade where you're down a lot and you didn't make the right decision to begin with to cut your losses. I'm sure you can all empathize with that situation where you decided to just wait a little bit longer to see what would happen, and you decided to ignore your stop loss. And because you ignored your stop loss, it resulted in the coin going against you even more, and then you're even down more in your position. And that's a horrible feeling. So then you make a decision, right? You gotta force yourself to really decide, what should I do in this situation? And then you wait more, and then it turns into a catastrophic loss. So a lot of people approach me and they ask me, hey, Phil, I'm in a really bad situation right now. I didn't stop myself out. I'm down like double digits in percentages, like 20, 30%, close to getting liquidated because they're leveraged as well. And then they ask me, hey, Phil, what should I do? And I never tell them what to actually do. I don't even look at the coin. What I always tell people, if you're in a really bad predicament and you got yourself there because you didn't stop yourself out, now you're just close to the brink of liquidation or something really bad and catastrophic happening. What I tell people is consider taking your loss. And the reason for this is because, well, it's showing you that you have the discipline to actually take your loss, which can translate to the next trade, forcing you to take your loss even earlier. It's going to come with a very expensive lesson, but nevertheless, it is a lesson that you will learn in a very, very harsh way. But you have to accept no matter what the consequence. If you do end up cutting your losses and the market does end up reversing, you can't say to yourself, shucks, I should have waited because the market ended up reversing and I could have lost a little bit less. That's not the best way to trade, because maybe you got lucky this time because you held on and you waited for the market to reverse. Maybe you got lucky the next time and the next few times after that. But there's going to be that one time where the market does not recover and you simply get destroyed. Ask yourself, if you waited and the market does drop even more and you got liquidated, how much worse would you feel? You probably wouldn't feel that great. You would say to yourself, I could have stopped myself a little bit earlier when I had a chance to, and look at the position that I'm in now. A lot of these situations that you're in, it's going to have an overwhelming amount of emotions added to your trading. And what risk management does is it tries to eliminate these emotions by having a very strict set of rules that you abide by so the emotions don't get the best of you. Oftentimes, before I go into a trade, I ask myself, how much money could I lose? I don't go into the market thinking how much I could win, because I know that good trades will result in making profit. When you make good trades, the profit is a bonus. Back in my days, I used to lose a lot of money to parabolic rallies because every time I saw this parabolic move up, I would try to jump in on it. But what ended up happening was I would either catch it at the top and then it drops down and then I panic and then I stop myself out. I lose a lot of money because parabolic rallies tend to drop just as fast as they go up. And then surely enough, the market ends up continuing to the upside. So parabolic rallies have this nature of just being crazy volatile, going upwards, downwards. And one time last year, I ended up shorting AXS with a $1.3 million position, and I took a $100,000 loss in less than 9 minutes. This was one of the most devastating trades that I've ever taken in my life. And here's the loss, $103,655. It was huge, this position. It was actually $1.45 million or so. So since then, I've made rules for myself to prevent this type of things from happening. If you have rules that prevents you from taking on too much risk and doing the appropriate things when it matters, it's going to prevent you from losing catastrophic losses like this one. So I just wanted to let you know that everybody goes through these trials and tribulations, and you have to persevere through these mistakes and use them as learning lessons. If you don't set these rules to prevent yourself from losing money, you're never going to be able to get to that level of professional trading that I know you could get there if you tried. And when it comes to being a confident trader, the confidence comes from making good trades where you end up being profitable. Let's say you're going to the gym and you're exercising every day, and the goal of that is to get fit, of course, right? But most people that go to the gym are extremely confident. And the reason for that is not because they look great. It's more so because they're consistent with what they do. They're promising themselves, I'm going to go to the gym every single day or 5 days a week, and I'm making a promise to myself to go there, and I'm going to commit to myself. So the confidence is developed from the habit that they're actually performing. They're going to go there every day and exercise. So combined with, of course, how they look and how they feel and making a promise to themselves, they're developing this consistency. That's the key. So when a trader becomes more confident, they're developing consistency as well. You're consistently stopping yourself out. You're consistently making the right decisions when it comes to minimizing your risk. You're consistently not taking parabolic moves that can make you end up losing a lot of money. You're consistently keeping your bankroll the same size. You're consistently keeping that position size the same. You're consistently not leveraging high or at all in any way. So these small set of rules, it prevents you from making huge mistakes. And this is why a lot of traders end up losing money. They don't focus on these psychological and emotional and risk management aspects of trading. And that's why in the first 3 parts, you haven't even seen me really open up TradingView for you yet, because I'm trying to give you the lowdown on what I think is the most important, and especially how it contributed towards me trading with $2,000 to begin with to trading up to $1.4 million like you saw in the trade that I just showed you. And of course, that $100,000 loss, it was a huge one for me. It was actually the biggest loss that I've ever taken in my life. But since then, I've made much more profit than $100,000. And it's been one of the best learning experiences that I've ever had, because it ended up developing these set of rules that I always uphold to never trade parabolic rallies unless. So when you lose, you end up developing these conditions and these set of rules that prevents you from making the same mistake again. And that's very important for trading, for you to take these losses and write a little book about why you lost and what you can do to prevent yourself from making these mistakes again. And another thing that's really important to manage your risk when it comes to emotions is your patience. Be patient and let the trade come to you. Don't try to force trades. Right now, I see a lot of people that are always itchy to make a trade. They're just wanting to be in the trade, but please understand that sometimes market conditions, it'll entirely prevent you from making a good trade or even finding a trade. For example, yesterday was Christmas. You're not going to find a lot of trades on Christmas. Today is one of the least volatile days I've ever seen this month and last month so far, when you only see one coin that's moving, for example, 5% and nothing else is moving more than 2%, and you're forcing yourself to take these trades. You're not being patient. We have to let these trades come to us rather than forcing yourself to take these very bad trades that could be detrimental. When you're always wanting to be in the trade, your goal changes. It's not to make good trades so the profit becomes a bonus. It's so that you can make profit. You're itching to make money. You need to find a trade. You've got these goals. Sometimes you just can't control the market conditions. But what you can control is how much you're going to allow yourself to risk, how much you're going to trade, when to stop yourself out. What decisions can you make? You can't control if the market goes up or down. You can't control if it's a volatile day or not. But the things that you can control, they need to be exercised and really respected. This is the difference between people who go into the market and lose everything and the people that actually end up thriving. So I just wanted to thank you guys for joining me for part 3, just talking about risk management and emotions and how to control yourself. If you're really interested in learning more about this, I've got a great course that can help you overcome these hurdles and also tackles them with a lot more depth. I offer the Technical Analysis Masterclass, and it's a 29-hour course over 54 videos. And the topics are immense. You can hear what other people are saying about it as well. You also get a lifetime access to my Day Traders Club Discord group. It's a private group with people who are like-minded, that want to succeed, that want to help each other thrive as well. And the curriculum has 54 lessons, and we go into trading strategy in high detail, my big 6 trading setups. We also go into the rules of trading, into cutting losses, disciplines, psychology, and we also go over live trades that tells you exactly how I'm making these profits using the trade and using the psychology, of course, that I've learned as well. And there's also a Day Traders full Discord access if you don't want to invest in the full masterclass course yet, which comes with the Discord. But if you just want to enjoy the Discord group to see how it is, because you're just getting your feet wet, this is a great choice for you to come join us. You get a live stream every single day with the Bitcoin Technical Analysis TA, a market scan, and also a watch list building. And I also try to trade with the group to point out what are good setups. And there's always lessons every day, very engaging to try to help people become the trader that they want to be. And you're also able to ask me any questions anytime that you want. You can get answers from anytime. I also have the Day Traders Club daily live stream. Everything above above comes with it, just so you know. But if you only want to get the daily live streams and that's all that you want because you don't have time to commit to the Day Traders Club, just check this out. It's $14 a month and you're going to get tons of hours of videos per day. So I hope to see a lot of you as my students, and I really want to thank you for watching this video. I hope that you've gained some insight about risk management and the psychology behind trading, and especially how it affects us. So I'll see you tomorrow when I upload part 4 for the Day Trading Beginner's Guide, where we're going to talk about much more fun topics than just risk management. So thank you for joining me once again. My name is Philakone, and I'll see you later. Bye now.